All right, this is Randy Finney with the right side of the chart, and today is Tuesday, January 30th, 2018. I'd like to go over some of the things I've covered recently. We'll start out with the broad markets. That seems to be where we're seeing some movement today. As posted earlier, we finally have those sell signals. I've been saying, gosh, for a couple weeks now, that we need to see all three of the indexes break below those 60-minute uptrend lines. The Nasdaq did, and I had to revise the trend line. I mentioned that often. The charts are dynamic, and so is my analysis. Earlier on, I had the trend line hugging these reactions here, but we saw yesterday the SPY had a perfect bounce off of the bottom of the trend line. We'll get to that in a second. So you can see, this trend line still has a lot of reactions, and most importantly, we limped through before. This is an impulsive breakdown, and finally, of utmost importance, we didn't have the Dow or the S&P 500 breakdown. So, as I often say, if you're trading the broad markets, I don't care if you're trading, in this case, the NQ, the Nasdaq 100, whether it's QQQ or the futures, you want to see all three, especially in a trend like this, a resilient uptrend. If you take a short on NQ because you see a support break, but the S&P 500 hasn't broken support, there's a good chance that that breakdown will prove to be a false breakdown. So either way, these are legitimate. We see the impulsive selling. You can see here, if you zoom in, I have this was on the chart posted earlier today. I don't know if you could make it out. Bear flag type action. We were right up in that flag earlier this morning, and we broke down. And this is textbook technical analysis. You see an impulsive move down leading up to the formation of the flag. The flag is this consolidation sideways to upwards consolidation, and then an impulsive break. This is a pretty key support level. This was listed on the chart this morning. It's been a good day traders market. Within the first 10 minutes, I was able to close an existing short I came in with, reverse it long, get a bounce, go short again, and that's it. I'm going to sit here and watch now. I want to say this: I don't expect um, much more downside today. Anything is possible, but this is one of the biggest down days we've had for a while. As I'm doing this video, the QQQ is down 1.09%. Historically, that's not a huge day down, but relatively speaking, to what we've seen since really the first of this year with this New Year's rally, that's one of the bigger days. But again, here's my thought process. I'm open to anything. Anything's possible. We break the support, it's a key support level, but you can see sometimes you get these intraday breakdowns and whipsaws. But what I wanted to say is that we still have all of the famed stocks: Facebook, Apple, Amazon, Microsoft, and Alphabet. They have yet to report. They are the big market movers. We have Janet Yellen on deck with the FOMC meeting this week. So there's a lot to come out, and I don't expect major fireworks. I do think we will continue to see more downside from this point, especially after the week is over, after everybody's reported. Maybe we get a couple big pops on some positive earnings surprises. But again, I think it's all priced into the charts here. We're extremely overbought. Sentiments at extreme. So what I'm trying to get at is this week expect some choppy action, and I just can't see the market melting down in front of the big five FANG stocks reporting. Um, but like I said, anything's possible, but I wouldn't bet on it, and that's why I had some shorts. Now I'm an active trader. If you're a swing trader, these breakdowns were sell signals. You may have to ride through a back test, and that would be, fairly painful depending on how much you have. But I think ideally for a swing trader, if you're going to trade the markets here, take a partial position. We have these breakdowns; those are sell signals, and then be ready to add to that position either at the end of the week once all their earnings are out of the way, sometime on Friday. Very few companies report after the close on Friday, just FYI. We'll have all the fangs will be out of the way by then. And then you can look at, expand your horizons down to these other targets if you're swing trading, and we'll go from there. So again, I think there is more downside to come, but right now, 1% drop in front of those stocks, I don't expect much more downside today. So those are my thoughts. Active traders, you want to try to game some bounces off these levels, that's fine. May or may not work, at this point, because we've already tagged that level a couple of times. Moving on, this is the S&P 500. Again, I'm looking at the futures chart. So this might look a little different if you're looking at the actual index or SPY, which those only trade regular hours. The futures chart kind of fill in all the blanks, so the overnight trading and everything else. So there it is. And this one I haven't had to adjust this trend line. This was just a beautiful, clean trend line. Usually when people refer to the broad market or the U.S. stock market, this is typically what they're referring to. This is the most diversified index. 500 stocks, the largest companies in the U.S. Um, the Nasdaq, as I've always said, is tech. Basically, I jokingly refer to it as a tech fund with an Amazon kicker because it's so tech heavy. So there you can see the same flagging type action. You can see the breakdown, a little kickback rally, a little back test right there, and then an impulsive move down. So these breakdowns are legit. There's the first support level I have, about 28.31. We're a little bit below it now, but again, these are 60-minute charts. Look at this. You want to see a 60-minute close. And again, you want to take all these indexes together. I just showed you the NASDAQ 100 at support. We have the S&P a little below support. Um, my max downside, I think, before we get all the fangs out of the way, or at least a few of them, a couple of them, would be this target here. You can see it at 2807. And again, I've covered these charts quite a bit in the past. The levels, sometimes I'll add an additional support level, but you can see them all marked here with the blue lines. And at this point right now, again, this week, until we start to get some of those stocks reporting, I just don't see much more than a move down here to maybe 2807. But please don't forget, there is an extreme amount of hot air in these markets. They are extremely overbought. Sentiment is through the roof. Valuations, as we all know, and that's a longer term fundamental thing, are excessive. They're insanely high right now. So nothing would surprise me. And I think in the coming weeks here, especially if this earnings season this week, we see some negative surprises. All the ingredients are in place for a flash crash type very swift, fast move down. I just want to say that they are there. But unless that happens, the overall trend is clearly bullish right now. So I'm just looking at this point for a correction, pull back maybe 5% or so. You can see some of the targets there. And again, this is the Dow Jones futures. We had what I call a wedge overshoot when you had a clean rising wedge. This trend line had a lot of reactions. We pop. I've talked about this many times over the years, showed these patterns. They're some of my favorite because when you have a wedge overshoot, you pop to the upside of a bearish rising wedge when normally you're looking for a downside break. What you typically see is a quick reversal back in and then immediately below the wedge. And that is exactly what happened here. But now you can see the Dow is right at support. I have a support line here, about 26,136, that blue line. We're a little bit below it, but again, 60-minute chart. I wouldn't be surprised to see it snap back up. If we don't, you can see the next support levels down here. So those are the broad markets. We're down today. These breakdowns are pretty impulsive, pretty convincing. Therefore, whether we have a little kickback rally or not, again, my point is I see more downside in the coming days to coming weeks, but I just can't overemphasize the fact that we're going to have some volatility here this week, as I posted yesterday with all the events on the economic calendar as well as the big earnings that we have this week. Here's gold. I've covered gold recently. Standing aside this one now, I've been calling for a pullback in gold for a while. It's starting to play out. Nothing major so far. Gold today is catching a bid because gold is a flight to safety instrument. And when the market's correct, typically you see money going to treasury bonds, gold, because they're flight to safety instruments. But overall, gold is too toppy, and I still think at the very least, the risk reward right now is skewed to the downside in gold. I think at best case scenario, even if it makes a marginal new high, I think we're going to hold here and consolidate for a while. Let me take a look at a daily chart here. This is GLD, the ETF. I had a daily chart already marked up. So what you can see here, you see negative divergence. That divergence looks like it's just about to be confirmed if we get a bearish cross, any more downside in gold. So we have negative divergence on the PPO. As well as the RSI. This is a daily time frame. If you're not sure what I'm talking about on the divergence, you have a peak here, reaction high, and a higher high at this point with the indicators making lower highs. We were overbought. So again, I think at best case scenario, gold needs to consolidate. And ideally, I'd see it coming back. I'd like to see it work its way back down, work off these overbought conditions. I remain longer term bullish on gold, have for the last year or plus now, and I think we can look at a little bit of a pullback here. So I'm just not interested in engaging this sector long or short now. I don't see, a major top. Although when you see negative divergence like this, it often does play out for major trend changes. We had divergent high back here, big correction there. So the possibility for a deeper correction, and you can see levels on my chart. At this point, let's just say 123.25-ish. That would be my maximum downside target right now. But again, my convictions on gold is not very strong. So let's just revisit this one. And of course, on a related note, there's GDX, same thing. I'm talking about divergent highs. In fact, we had another divergent high right here. It's not marked on this chart. You can see these indicators just continuing to make equal or lower highs with prices making higher highs. And so far, that started out, and GDX is correcting. Keep in mind, GDX doesn't benefit as much as gold does normally when the market's correct or in sharp sell-offs. GDX, holds gold mining stocks, and yes, they benefit from the price of gold. However, they are equities, and so during sharp sell-offs in the market, it's not unusual. And you can see right here today, we're down about a 0.5% in GDX, and as I just showed you, gold is up, and that's a flight to safety bid. So, uh, of the two right now, if I were to be short one or the other, in fact, I do have sorry, in some accounts I do have a position, a short on the miners, but that's where I'd be. But I have no desire to be short gold right now because of the reasons I just stated. Crude, I still think crude's at, a major top. I'm looking for an intermediate term correction, short to intermediate term. I'm still longer term bullish on crude, but for a while, I don't plan to be long crude again for a while. Something I'm short. We're short in the energy stocks, as you guys know, XOP. You can XLE. I think I put on XLE as the official short, but I'm also short. I like you get more bang for your buck out of the service and XOP, XES. Those tend to go down more than XLE, but I put XLE on as the official trade for several reasons, including it had some pretty well-defined levels. But if we look at right now, let me give you a level here on crude. We're dancing on a pretty decent support level. You can see some reactions right here. So crude's starting to crack below that, but I see more downside in crude, and I've made that case for a while now, both on the daily and 60-minute charts. And crude and the energy stocks have more downside to come, I believe. Silver's holding up relatively well so far. It had this little breakdown here. This looked like the real deal, but that was a bear trap, false sell signal if I've ever seen one. We broke down. It looked impulsive, but boom, snap back. So that's still a level to watch. So far, we've given back almost all of that snapback recovery rally once we regain that level. So just keep an eye on that level. But if you're trading the miners, gold's going to have a bigger impact on it. And then there's platinum as well. Okay, and you might remember a couple months back and put on we had GDX gold, I think it was GDX, the official trade. And I made a case for gold rallying, and it did, and it also followed up with platinum being my favorite of the metals at that time, and PPLT was one you can trade. These are platinum futures, and they certainly did rally, but I've been making the case, the precious metals were too extended. You had this divergent high right here. You had a bearish rising wedge, of impulsive breakdown. So you can see that clean breakdown there of the rising wedge pattern, and all we did is we had a kickback rally. We back tested. That's the same trend line extended. We back tested for a little while, failed, and we've since been moving lower. So I see more downside in platinum. This is a key level right here if you're trading it in the futures, 992.65. Very well defined support level, several reactions so far. And I think once that breaks, which I think it does, we come down here to this level right here. And any of these targets on this chart. Commodities continue to firm up. I'll look at these if we have time with the ETFs, but these are futures, soybeans, wheat. I've been making a case for a while now, and I think that's where we're going to start to see a lot of money move. I think, and I've said this for a while, I think there's limited downside in commodities at this point. The risk reward is tremendously better if you're looking out a year plus in commodities. Mostly, I'm referring to ag commodities. They're all different. Oil has nothing to do with wheat. So we're looking at wheat futures here. But I really like those longer term. They're not get rich quick stocks. You're not going to, or trading instruments, I should say. But I have seen rallies. I've seen things like coffee and wheat prices and all that post pretty quick gains. They can be volatile, but I think, again, for a long term account, position, I think it makes sense to have a portion of your money in commodities, both as a hedge to your equity portfolio and as a reinflation trade. They've been knocked down. Anything dollar sensitive has had the snot knocked out of it. But I think you're going to see, especially some of these ag commodities, do well going forward. And I'm talking again, both intermediate term right now and longer term. All right, let's see what else. Not much else to cover. I mentioned utilities. I still like those. We had support here. We bounced so far. Look like the PPO's crawling over. We might get another thrust down, and I could see that, but I think the downside is limited. So here's another one where I don't see any explosive gains, but I think the risk reward is favorable, much better than tech stocks and things like that right now, even though that's where the momentum's been. So in other words, by risk reward, I mean I believe that the next, let's say 10% move in utilities from here will be to the upside before it will be there's 10% right there before it will be to the downside. That's how we quantify it. So minimal downside. Maybe if things get really ugly, we have about another 4% from where we're at right now to about this 48-ish level, 48.32. Um, and again, I can see that possibility. But what I like about these, and again, long-term accounts, you get paid to wait. This one alone is, this is just ETF, and it's paying about a 3% dividend yield. Not great, but a lot better than what your bank is paying on your savings account or money market fund or even CDs. MJX, the marijuana stocks, have made it clear. I think that the top is in on these guys. If you haven't booked profits, I've been pounding the bullish drums on these for a long time. But this run that we had was too much too fast. A lot of it was driven by inflows into the CTF. We had a divergent high here on the daily chart. Remember, everything on MJX before this point here means nothing because that's when it was a Latin American REIT or real estate ETF. But there it is. You can see 60-minute chart, daily chart. Everything confirms that divergent high. So again, I'm out of the pot stocks for a while, and I will look for the next entry. But I can just tell you this now because I do get inquiries. And if you're a member of the site, please, anytime you have a question on something, bump me. But I don't have my opinion will not change on these for a while. There's some support right here. You can certainly try to game a bounce trade, but it's not super well defined. But I just think for the foreseeable future, let's just say for the next few weeks to few months, I think the trend will be down in the marijuana stocks. Semiconductors, I still think this will be offer one of the most profitable shorting ops in 2018. They haven't broken yet. They're still above trend. I've covered this extensively in some videos recently. SOXX, XSD, and SMH, the three main semi ETFs that I cover, they all have nearly identical uptrend lines. So that's where your longer term, more powerful sell signal will come. But the most recent trade we had here is, short at the midpoint of the channel, and so far that's profitable. Nothing to write home about, but I still think it's priced into the charts. And by the way, we have AMD, Advanced Micro, reporting after the bell today. Here's a 60-minute chart on SOXX. We have had a divergent high right here. You can see the negative divergence, just like we had divergence here, and that was pointed out at the time. We broke support here. This was your uptrend line. There was your divergent high, about 10% correction. Here we had a similar contracting channel slash rising wedge type pattern, breakdown back test. We hit the first support level I have here, 181.78-ish right there, bounced. We need to take that out. When we take that out, this is a pretty significant support level. You can see if you look at the chart here, just go back, you can see we've had some reaction highs here, reactions there, and that reaction. So this is what you're looking for your next sell signal. And then again, most importantly, is an impulsive breakdown in daily close below that uptrend line on the daily chart that I just showed you. Okay, just to wrap it up, like I said, I like the commodities. Uh, I looked the other day. I thought wheat was an active trade on the site, and then I realized I need to update some of the trade ideas. It's still listed there because I never posted the last time the last trade was stopped out, and all along I thought that I re-entered it here officially on the breakout of this downtrend line and backtest. Pretty sure I showed that. Either way, breakdown, backtest. Look at that beautiful move so far, coming up to what used to be no, that was a that was a stop line. This is a key level right here, 660, and I always really put my primary focus on the futures charts. These ETNs, they do actually a pretty darn good job. The agricultural commodity ETNs, the grains and such, whereas some other ones like natural gas, those ETNs do a pretty lousy job of tracking prices over time. These do a pretty good job. So this one you can expect probably a continued move up here to the 660 level. There's a little resistance here, but again, the case for a bottom can be made, I think, on a lot of these stocks. So there's wheat, here's NIB, or that's cocoa. That one's been moving up lately. Soybeans been moving up lately. CSOYB, corn starting to move up. We had a divergent low here. I guess this is an official trade. Maybe that one, yeah, if I have a stop there. The first target there. And let's see what sugar. Sugar looks like it's finally turning up here. And JO is coffee. Coffee hasn't yet run, but we had a divergent low recently at this point, and so there's still some potential there. But keep in mind that some of these, even though these are ag ETFs, some are ETMs or agricultural commodities, I should say. Some don't have any relationship to the others. And if you want to spread it out a little, where is it? DBA. Here's an agriculture fund ETF. You can go with this one here. There's some levels. And then JJG is the grains. This is corn, soybeans, and wheat, if I'm not mistaken, all together. So this is a nice clean chart, divergent low, breakout, very well defined, falling, contracting price channel. And this is clear as anything to me is this target right here, about 2687. You can see what an important support level that was in the past. We were able to make some trades off that in the past with these divergent lows. And so, yeah, you're going to run into a little bit of resistance here around 2610, probably have a reaction, but ultimately I think we work our way up here to 2684. And if and when we regain that level, I think that's a pretty significant level, and that would open up the longer term bullish case. Right now, I'm looking at, swing trading up, which is about another 5% or so up there. All right, let's wrap it up here. This has been Randy Finney with Right Side of the Chart. And just remember, strap in and hold on this week. We're going to probably see some increased volatility like we have so far this morning. And then once the dust settles by Friday, early next week, we'll probably have a good idea of whether this market is going to continue to be bulletproof and just rally. But like I said, there's just so much priced into the charts, into the technicals. These overbought conditions, all we need is a spark right now to ignite a pretty sharp correction, even if this great bull has some more life left in it and it's going a lot higher. Again, I'm looking right now near term, and looking for a pullback in the markets here of at least 3, if not 5% or so from the recent highs. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.